Hi, everyone. I am super excited to be here today. So I have been attending TMLS as a attendee, as a volunteer. So I've done emceeing like my friend Susan. I've been a timekeeper, and this is my first time attending as a speaker. So I'm super pumped to be here and really thrilled that you all decided to come join my talk about alternative data in investing. So I guess once again, I am Serena, and I'll tell you a bit about myself before we begin. So, I'm a lead data scientist and quant researcher at Delphia. So Delphia was founded on the premise that people should be able to capitalize on the value of their data by using it to gain access to top-tier investment opportunities. So Delphia runs a retail investment strategy that aims to enable its members to build wealth by investing their data. So Delphia also runs a hedge fund for accredited investors, and this is the part of the company that I work for. So I sort of say that Delphia has two sides to the company. There's the side for people like you and me with the retail investment product, and then there's the side for people not so much like you and me for accredited investors. And in its first year, the hedge fund was the 5th highest performing long-short equity fund as measured by single-year performance in all of hedge fund history. And as a founding engineer on the hedge fund team, this is an incredible accomplishment, and I'm super proud of what we've done. So in terms of my work at Delphia, what does this mean working at a hedge fund? So specifically, I do machine learning to predict stock fundamentals. So this involves everything from data and feature engineering to feature selection and model development. And when I say I use machine learning to predict fundamentals, I mean I predict things like sales. I'm also, as Susan mentioned, a co-host of Deep Random Talks, which is a YouTube talk show and podcast focused on machine learning and product development. So if you Google Deep Random Talks or look it up on YouTube, it should come up as one of the first hits, so please do check it out and maybe leave some comments on some of the videos. I also do recommender systems and NLP research with a particular focus on session-based recommendation and cybersecurity applications, and recently I've published several papers at IEEE conferences, so super exciting as well. A bit more personal, I enjoy playing soccer and riding my bike, even in the winter, even in the rain. I biked to the conference this morning, which was a bit of a mistake because I was quite soaked. I also foster dogs, and fun fact, I was recently named one of the top 25 women in AI in Canada by Rework, which is another conference organizer. So let's get into the talk. So in this talk, we will cover case studies to highlight the advantages of alternative data in investing. We'll also go over the promise of alternative data in quantitative equity strategies in particular. So we'll start with being a bit more general, and then we'll get more specific as the talk moves on. And then we'll be a bit pragmatic near the end of the talk, and the third section will focus on the challenges of working with alternative data using Delphia's equity strategy as a bit of an example to guide our discussion. So this is a talk about alternative data, so let's define it. So when I think about alternative data, I'm referring to really what it is not. So alternative data is not traditional. So let's talk about what is traditional data. And by the way, this term alternative data was quite sort of unfamiliar to me when I started my time at Delphia, and this is just my take on it. If you ask another asset management practitioner, they may give you a different answer. But traditional data are things like analyst estimates, earnings reports, and market-based data, so things like prices. So momentum is a very common feature used in quant equity strategies that is derived by price. It's sort of like a recent time series of price. So alternative data, like I said, is everything that is not traditional. So alternative data includes things like social media, surveys, earnings call transcripts. So this would be taking earnings reports and applying NLP methods to the earnings reports. That is innovative enough and unique enough that that is considered alternative data. Geolocation is another example of alternative data. Tweets, which is a subset of social media, of course, etc. So Again, what I can hope you all take away from this is that when you think of alternative data, think about what it is not. It is not traditional. So if you're presented with a data source and maybe some data vendor says to you, this is alternative, you can think, okay, does this fall into the category of analyst estimates, earnings reports, or market data? If yes, it's not alternative. If no, then it is in fact alternative data. Okay. So now that we know what alternative data is, we can get into some case studies. So each case study will follow the same format. We'll talk about what the data is, and then we'll talk about why we would care about it in investing in general to start. So our first example is related to one of our favorite people, Elon Musk, and his company Tesla. So what is the data? So a few years ago, Quandl, a Toronto-based company before they were acquired and became NASDAQ Data Link, they obtained a data set from insurance providers. So this data set included information on insurance registrations of Teslas, and crucially, this means that this data set referred to cars that were actually delivered. So for a company that operates so heavily based on pre-orders like Tesla, it's crucial to understand how many cars actually go through to the delivery stage. And if a car has been delivered, it must have already been sold, if a car has been delivered and sold, then if a car has been insured, it must have been delivered and sold. So that delivery would be included in the company's sales numbers. So why would this car insurance data set be useful? Well, first of all, this was a weekly data set which allowed weekly tracking of sales. And given that public companies like Tesla announce their sales numbers every quarter, this weekly measure makes for a very high frequency measure of a lower frequency target, which will really help your prediction exercise if you're trying to predict sales. And in particular with Tesla, this quote you can see on the screen is from when the dataset first became available, and it describes why the dataset was so useful, so I'll just go ahead and read it. And it says that industry analysts are not convinced that Tesla will meet its target, but the degree by which they will miss is a subject of great debate. So Quandl's dataset can help investors determine Tesla's progress ahead of analyst estimates and production reports. So what does this really mean? Well, this means that analysts at the time, they were in consensus that Tesla would not meet its target. So the question wasn't really, will Tesla meet its target or not? They all thought Tesla would miss. The question was really, by how much will Tesla miss its target? And this Quandl dataset provided a strong hint at the answer. So our second example is related to JetTrack. So JetTrack provides flight information for 1,700 aircrafts across 25,000 airports, and notably, these planes are operated by public companies in the Russell 3000, hedge funds, and private equity firms, and I think all of us would be super lucky to get to ride on one of these private jets maybe someday. So why is this useful? Well, just think about it. If you have access to this sort of data, you can see where these CEOs and other C-suites at these companies are traveling, and you can see who they're meeting with. And this quote describes how useful the data was, and it says, "This data has been used in numerous cases to predict corporate events, like when Constellation Brands kept flying up to Ottawa at an increasing frequency before making a $3.8 billion investment in Canopy Growth Corp." So, if your investment strategy relates to corporate events such as mergers and acquisitions, this sort of jet tracking data set would be very powerful to have a hold of. Our third and final general case study relates to the Chinese economy. And we're going to be talking about a company called SpaceKnow. So SpaceKnow provides what they call ultra-large-scale planetary analysis through satellite imagery. And I take this to mean that they use computer vision to analyze satellite images, and they can identify cars, boats, trees, container ships, swimming pools, all that sort of stuff. So SpaceKnow created an index called the Satellite Manufacturing Index, which was a play on China's Purchasing Managers Index. And they did this by analyzing images that were indicative of manufacturing activity in China. So why is this useful? Well, the PMI and therefore the SMI can be used to predict major economic activity like GDP. And by the way, other countries have PMI measures as well. For example, the US PMI is very important as a leading indicator of GDP of the US economy. And this quote describes it quite well. So it says that SMI is an independent measure that's published more frequently than the PMI, every Monday, Wednesday, and Friday, making it the fastest and most reliable gauge of Chinese industrial activity. And crucially, anytime you have a faster signal of something that's economically meaningful, this is very powerful in investing in general. So far, we've talked about the promise of alternative data in investing in general. So we talked about mergers and acquisitions, for example, with the JetTrack dataset. Let's switch gears a bit and talk about the promise of alternative data with regards to equity strategies. And that is, if we want to buy and sell stocks, for example, what we do at Delphia, how could we make use of alternative data? So let's talk about credit card transactions. And this is actually an example that we used at Delphia as a piece of educational content for our users a few years ago. So just imagine for a bit and humor me that I could see, so Serena could see all of your credit card transactions. So imagine I knew whenever you visited Starbucks, and I didn't necessarily know that you bought a venti decaf latte with oat milk and vanilla syrup, but I knew how much you spent every time you visited Starbucks. And this is perhaps a bit invasive, but data vendors do in fact have access to this sort of information about you. And now let's take this a step further and imagine that I could see this information, not just for you, but I could see these credit card transactions at Starbucks for all Starbucks customers. So why would this be useful? Well, many quant strategies focus on predicting fundamentals like sales. For example, Delphia falls into this subset. And in fact, the strategy is so popular that it's often referred to as quantamental. So a quant strategy is one that systematically predicts some target, so sales, for example, over thousands of companies. A fundamental strategy, on the other hand, relates to predicting fundamentals of companies. So fundamentals are things like sales, EBIT, maybe EBITDA, net income, that sort of thing. The combination of fundamental and quant is called quantamental. So in a quantamental context, then, credit card transactions can provide a very powerful approximation of sales. So you can hopefully see how predictions of sales could become much more accurate with access to credit card data, as illustrated by this Starbucks example. Again, really just imagine that you could see this not just for one person and not just for one store, but for all consumer-facing companies. It would be very powerful to have access to this data. Now, another example of alternative data that can work in a quant equity strategy is the Consumer Confidence Index. So the Consumer Confidence Index, also referred to as the CCI for short, and you'll hear me throughout this talk calling it just CCI, it's an index that is published monthly, derived from survey data. So some people do view it as a leading indicator of the overall health of the US economy. Others might say that the CCI is garbage and doesn't signal anything. But in general, you can think of the CCI as providing an indication of future developments of household consumption and savings. So a CCI of 100 or higher signals a boost in consumer confidence towards the future economic situation of the US. And as a consequence, consumers will be less prone to save and more likely to spend on major purchases in the next 12 months. A CCI value below 100 indicates a more pessimistic attitude towards the future economy, and this could result in a tendency of consumers to spend less and save more. So the CCI, if you think about it, it can be used to predict consumers' propensity to spend. So then you can draw the link between CCI and sales of products made by publicly traded companies. And it is actually possible to create a weekly measure of the CCI using survey data, and this is actually something we did at Delphia for a few years. And it involves asking people questions that are as simple as, compared to this time last year, how do you feel about your current financial situation? And I want to draw your attention to the figure on the right-hand side of the slide. And this shows interest rate expectations, which is derived itself from the CCI. And then we can compare this to actual changes in interest rates. So you can see that the CCI here, when you derive interest rate expectations from it, it is a leading indicator of true real interest rates. So there is that value in what consumers know and what consumers are thinking and feeling. So why is this useful? Well, beyond what I just mentioned, if you were to create your own survey to measure CCI, you could create a faster measure of a well-known economic signal, which, as we discussed already, is extremely powerful. And really, in investing and quant equity strategies in particular, when it comes to information, you either want to know information that other people don't know, or you want to know that same information, but faster. This would put you at an advantage, knowing that same information before everybody else. And then if you can encode that information, this can provide a boost to your predictions in your quant strategy. So for example, you could take a position in a stock before the rest of the market piles in. And finally, I want to draw your attention to this figure. This shows current CCI. So take a look at the cliff that we've fallen off of in 2021 and 2022. So looking at this, do you think we are going into a recession? So at this point, we have discussed the promise of alternative data. First, in general, we talked about JetTrack, Tesla, and SpaceNote. And we also talked about alternative data in equity strategies in particular and discussed the CCI and Starbucks and credit card transactions. So let's be a bit pragmatic and talk about the challenges of alternative data using Delphia's strategy as somewhat of an example. So the first challenge really is that humans are biased and we care too much about what other people think. I know me standing up on the stage, looking at the crowd, I do care about what all of you think, and I hope you're enjoying the talk so far. So let's say we were tasked with creating a survey to forecast the results of the US midterm election results. So let's say we were doing this a few weeks ago. If you were to ask survey participants, who are you going to vote for in the election? They might not even know it, but they might end up saying what they think you want to hear. And this will result in a poor forecast. So the mitigation for this is quite simple, and really this is the question of how do you survey people by and ask them questions that will get to the true answer without that bias. And the mitigation is actually quite simple. So don't ask them who they plan to vote for, ask them who their friends, their neighbors, or their colleagues are going to vote for. And maybe this seems surprising, but this was demonstrated by researchers who forecasted election results using this wisdom of the crowd methodology. So essentially, if you ask people who their friends are going to vote for, you can predict elections. And the wisdom of the crowd, by the way, is the theory that the collective knowledge of a group is better for decision-making and problem-solving than the knowledge of one individual. And to connect this to a quant equity strategy, this means that, let's say you were attempting to survey consumers to determine their spending habits or maybe determine if they were going to pre-order some Teslas. It would be best to ask them about their friends' habits, not theirs. And by the way, the researchers who I mentioned who forecasted election results using the wisdom of the crowd are people I worked with at Delphia. And this work based on election results and wisdom of the crowd is what really spawned the work and spawned the whole company Delphia in the first place. So that's a cool fun fact. So a second challenge in dealing with alternative data is that it isn't enough to obtain alternative data from a data set, any data set. We need to care about the data being representative of the overall population. So what this looks like in practice is when a data vendor maybe reaches out to me, because I work at Delphia on the hedge fund side, they might say that they have a data set for me that they want me to look at. Maybe they want to charge $20,000 a year for it or even more. I have to be very careful about asking certain questions about the data. And really, we need what's called a representative sample most of the time. A representative sample is a subset of a population that seeks to accurately represent the characteristics of that larger population. It often yields the best results in prediction exercises, but it can be the most difficult to obtain. So let's use the example of creating our own consumer confidence index, so CCI, using survey data. So if we were to survey every single person in this room, we would probably not get a representative sample. We are all interested in tech, machine learning. We all likely live in Toronto or the Greater Toronto area. Some of us might have flown in, and those of us who flew in for this event are well off enough to fly, of course, or have employers that will pay for us to fly. So the outlook of this group on the overall economy would not necessarily represent the overall population's outlook. So how do we mitigate this? Well, we can use a method called post-stratification, and it can be a bit wordy, but it's really where you adjust the weight of the undersampled and oversampled populations in order to obtain an overall final sample that is representative of the true subpopulations distributions and of the actual target population. So really what this means is you can apply some sort of reweighting algorithm to survey respondents' answers, and conditioning on demographics, you can obtain a representative sample. And a caveat with post-stratification is that you do need to collect demographic data up front when collecting survey results. So you need to get that consent from the survey respondents to get information about their demographics. And you do need to know what the overall target population's distribution looks like, which is quite easy if you have access to census data. So again, having a representative sample, it's a concern, but there are steps that can be taken to mitigate this. And this brings us to the final challenge in working with alternative data. And I mentioned that if a data vendor approaches me, I will want to check that the data is representative. The second thing that I will usually want to check for is the cross-sectional breadth of that data set. And I would say that this is the largest challenge in working with alternative data in a quant equity strategy, which is that you need this cross-sectional breadth, which I will explain in a moment. So quant strategies, they often trade thousands of stocks in a single portfolio. So this high number of securities, according to some, is actually what defines a quant strategy. So that quality, that is having a signal made up of thousands of stocks, this is called high breadth, high cross-section. You can use those two terms, and generally people will know what you mean. So having one signal defined for a single company, but having it be null for every other company in your investment universe, so 1 out of 3,000, it wouldn't really do that much. So to put this another way, the question is, how would it help us knowing consumer sentiment towards Twitter, or I guess now Tesla, if our machine learning models only have that feature defined for a single company? So the mitigation here is to investigate low breadth or low signal strategies and models potentially. So this is something we're doing at Delphia right now and we're very interested in. So for example, we are currently doing studies to understand sort of the true breadth requirements of our models or of our strategy. That is, do our models require features to be defined for 10% of the companies that we trade? Is it more like 50%? I think what we would hope as a result would be that we only need it defined for 1% of our companies, but that's not what we've found so far. So please do reach out to me if you have any thoughts or experience on working with these sorts of problems. Again, this is something that we are very actively interested in. And yeah, that brings me to the end of my talk. I need to share some caveats first of all. So Delphia does not currently use any alternative data. It's something that our sort of overall company is relying very heavily on in terms of our investment thesis, but to this point we have been sticking to traditional data sources. And as a second call to action, I would say we are hiring a ML ops engineer, cloud engineer, data engineer, infrastructure engineer, that sort of role. We haven't fully mapped it out properly, but if you're interested in working with me and working on cutting edge asset management problems, please do send me an email to serena@delphia.com. And if you would like to connect with me sort of on a more personal level, you can email me at my personal email, smmcdonald@gmail.com. And happy to be connected on LinkedIn. Just let me know that you attended my talk at TMLS, and I'll gladly accept you. And then finally, please do check out Deep Random Talks, which is the YouTube podcast and show that I co-host. So thank you.
If there are any questions?
Thank you. Okay, so I have a two-parter. Right here.
Okay, I couldn't see you. Thanks.
Okay, right. I have a two-parter. So you mentioned earlier that there are companies, or you track the jets of CEOs or chief executives within companies and basically evaluate that. Have you identified scenarios wherein CEOs or any chief executive fake flew their jet out somewhere to sort of trick you guys into I don't know, bad prediction?
That's a very good question. I am really not sure. I guess I would just rationalizing it, thinking about the incentives. I always think about when it comes to money, what are people's incentives? So in this case, I would assume that a CEO would not just send their jet one place to throw off another company, because that's probably quite expensive. But let's say that they have they're competing with another company to try to acquire, like company A and B are competing to acquire company C. Maybe in that sense, since there's so much money on the line, the incentive system might work out that a CEO might send their jet somewhere else to throw off company B. I'm not sure, but I haven't heard of that happening, but that's funny. I mean, I guess anything is possible when there's billions of dollars on the line, right?
Second part of the question. So, how does Delphia, or your company, prevent other people from using the same techniques that you employ to track you and how your company is doing for that particular quarter?
Yeah, that's a good question. So I think there are things that we are allowed to share very openly. For example, everything that I've shared today has been passed through compliance and given the go-ahead. I think I mentioned that I would talk about Delphia's strategy, but what have I really shared? I said that we are predicting some sort of fundamental, we're doing something at scale, and we're having trouble incorporating alternative data into our strategy. Beyond that, I haven't said much, so I think that's how these hedge funds tend to keep their IP to themselves. They just are very secretive, and I think one interesting thing about Delphia, given that it is a tech company that has like an in-house hedge fund, I would say we are a lot more open than most hedge funds. I think certain funds, you wouldn't even be able to figure out like what alternative data sets they might be using, or even what sort of traditional data they use. So I think it just comes down to like having very tightly sealed lips.
Awesome. Thank you very much.
Thank you.
Thank you. Great talk. Thank you, Serena. So one question I have for you is, so Delphia is not using alternative data, you said, right? So it's using traditional data sets and traditional data. So what are your thoughts on fundamental indexation? So I know this has been quite a bit of a big topic in a couple of years. I remember like a few years ago when research affiliates came up with their fundamental indexation paper, and then a lot of things actually kind of came out of that. So what are your thoughts on that? So instead of the traditional
Was it fundamental what?
fundamental indexation, so using your traditional market metrics like sales, EBITDA, and all of those, instead of weighing your index by market cap, you use your value kind of metrics to kind of rank your stocks. So what are your thoughts on that?
Interesting. So rather than ranking by market cap, you would rank by some sort of fundamental?
Correct.
I think that is very fascinating, because I think given that, and again, I can't really share much beyond my own personal thoughts. I could get into what Delphia's thoughts are, because I actually do know the answer to that question. But in terms of when you think about the post-earnings announcement drift phenomena, which I assume you may be familiar with, because it seems like, yeah, you know what you're talking about. Like that would be given when a company files their quarterly reports, if the sales are much higher than what analysts generally expected, there's this phenomena where the stock price will drift positively and continue going upward for the next 6 months. So I think just based off of that idea that the post-earnings announcement drift phenomena exists and is very well known, I think scaling by that sort of, I guess, the surprise value could really make sense. And I think that must be being done at certain hedge funds. And I think from what I've seen of people who work in the hedge fund industry, all those sorts of things are tried. So scaling by market cap, that would be something that would go into the back test. And I think there would also be back tests to scale by sales and other fundamentals as well. Yeah, so I think you're on the right track.
Yeah, I did an experiment a couple of years ago where we kind of did 4 or 5 different portfolios with different metrics, and then we compared it against S&P 500, and by all means, it just outpaced S&P 500 by, I would say, like 120 to 200%. So,
Wow.
yeah.
That's very impressive.
But then that's barring like any fees or anything, and then your I think your pocket is like limitless, right? But if you
Yeah.
put on those constraints and whatnot, I think it'd still be a good strategy.
Very cool. Thank you for that question. Any other questions? Yeah.
Yes, thank you for your engaging presentation. I very much enjoyed it. I'm wondering, how are you integrating, if you are at all, climate risk data into your analysis, whether whatever company you're investing in has made the investments necessary to adapt to new climate conditions?
Sorry, do you mind repeating the question? The microphone's a bit fuzzy for some reason.
Yes, I'm wondering if you are integrating climate risk
Okay.
data into your assessments.
Climate, like the actual climate, or sort of like the financial climate?
Environmental, social, and
Oh,
governance
ESG.
metrics.
Okay, so ESG, I think, is very interesting. At the moment, we, again, are sticking to very traditional ways of looking at quantitative investing. So we're not currently tracking any ESG sort of measures. That being said, it is something that we're investigating. I mean, for myself, I think ESG is something that's very important, and I can see in the future we may have a sort of ESG fund. And by the way, at Delphia, the retail investment product is actually a sort of subset of the overall hedge fund product. So we have this product that is available for accredited investors to invest in, and then for people like you and me, we're able to invest in a subset. So one such strategy that Delphia provides to retail investors is a consumer index fund. So there could very well be an ESG sort of fund, but yeah, right now we're not doing anything ESG related. But great question.
What is Delphia's investment review process? Like when you build a model with rate predictions, how do you pass that along to the investors? I know some quant strategies revolve around high frequency trading, in which that investment review process might get skipped. But I'm just curious at Delphia what the process is.
Yeah, that's a good question. So Delphia follows sort of a very traditional, I would say, value strategy or value fund way of graduating new investment theses into production, and that is we have an investment committee. So the investment committee is made up of 4 portfolio managers, the chief investment officer, and our head of machine learning research. All of these people have at least 25 years of experience, and for me, I'm quite a few years or maybe decades off from actually seeing what happens in the investment committee. But any sort of new model or new finding that I come up with as one of the researchers, it has to go through the investment committee. So hopefully that answers your question.
Yeah, thank you.
So in hedge funds, oftentimes signals have a degradation because you have competitors also looking for the same signal. And over time, the alpha that you generate kind of disappears. What is the typical life cycle like for a signal that you see? Is it months? Is it years? Yeah, just kind of curious about that.
Yeah, I would say so. I think it's different for every strategy. We recently had a discussion with people at another hedge fund based in New York, and they were saying that their signal degradation was maybe on the order of months. At Delphia, it's been more like years. So we have done some tests, and it seems like the signals that we use in the overall strategy, we have maybe like 5 to 10 to 20 sort of years left before everything starts to degrade. Of course, there could be, like, let's say I quit today and went to start my own fund and managed to get a bunch of AUM. Maybe that would contribute to the signal degradation speeding up a bit. But yeah, Delphia, the strategy is quite long-term relative to other hedge funds.
Thank you.
Thank you.